Foreign funds are selling, but local share buybacks have helped support the markets. The question is whether that support can hold. This week, I'll share with you my full investment process to tie together everything we've discussed so far. My name is Dan Slim, and welcome to another episode of Monday Market Outlook. US core inflation came in with just the tiniest month-on-month uptick for September, delayed September, which already feels like forever ago, but it's still the last meaningful data point the FOMC has before this week's decision. And the odds are lining up nicely for a labor market-driven rate cut. CME Fed Watch now puts the chances of a 25 basis point cut at 87%, which would bring the target range down to 3.75%. Rate cut optimism also got a boost from Friday's Michigan consumer sentiment reading, which finally turned positive for the first time in 5 months. Back home, the Philippines manufacturing PMI fell sharply to 47.4, its weakest level in 4 years, as output and new orders dropped because of weather disruptions and soft demand. According to S&P Global, this marks the strongest deterioration in operating conditions since 2021, with declines also seen in exports, purchasing, and employment. With lower orders and softer demand, perhaps this is why inflation surprised to the downside, coming in at just 1.5%, a bit below economists' expectations of 1.6%. But the lower inflation print could also be just from a high base last year, as well as significant easing in food costs. With the year almost over, the now lofty 5.5% growth target for 2025 has become extremely unlikely and would require at least a 7% GDP fourth quarter performance. The DBCC will meet this week to review their assumptions, but we all know assumptions can sometimes be the root of all disappointments. Growth projections have also been downgraded from 5.6% by the OECD to just 4.7% this year. 2026 targets have also been downgraded to 5.1% from 6% previously. And again, blame it on the floods and flood control projects. Now, with the tame inflation numbers and perhaps the GDP downgrades, the BSP is expected to cut rates this December 11 after the Fed announcement 11 and a half hours earlier. So both central banks are poised to cut rates by 25 basis points at their final meeting. And while the US and the Philippines continue with the rate easing cycle, the Bank of Japan caused a stir when Governor Ueda signaled that this December 18 meeting is on the table for a rate increase. So markets now expect the Bank of Japan to likely raise rates from 0.5% to 0.75%. Now this stir pushed Japan's two-year yield sharply higher, hitting 1.03% before surging to 1.047% last Friday. So that sudden jump, usually when yields jump that fast, it will trigger a liquidity shock as leverage investors and hedge funds were forced to unwind yen-funded positions. So the rapid move in short-term yields amplified volatility across global markets as carry trades were forced to unwind. Bitcoin was caught in the crossfire as well, briefly sliding to 84,000 before aggressive dip buyers stepped in and stabilized the move. Meanwhile, the dollar index also sank sharply and later hovered near 98.98 as higher Japan yields strengthened the yen, and the reset was also exacerbated by the expected Fed rate cut this week. But for emerging markets, the unwind was harsher. Funds exited higher risk assets, leading to sell-offs in Philippine stocks and bonds and putting immediate downward pressure on the peso. So when you add the recent GDP downgrades and the BSP's position to allow more market-driven exchange rates, the peso really had little support and quickly drifted back towards its previous highs near 59. Now let's take a look at the local markets. ICT single-handedly trying to keep the index afloat with its market cap now at 1.1 trillion, overtaking SM Investments. ICT surging 6.44% on the week, while SM has fallen from grace, plunging to just 8.68 billion in market cap. Thanks to ICT and corporate share buybacks, they were enough, no, to provide a relief bounce. While the index pulled back 2% last week, the market managed to stay above the 0.38 fib at 5885 to keep investors' hopes alive that the market could still rally into the holidays. Coming into a shortened trading week and a long weekend, hopefully we could get some renewed buying interest, especially if the index can continue to hold above, no, 5,900 at least. A sustained defense of this zone could keep the door open for a move back towards the psychological resistance at 6,000 and eventually another attempt at the 6,100 consolidation area. But, with the Japan carry trade unwinding, that's my fear. It could put some selling pressure into the markets, and failure to attract buyers early next week may send the index back to retest deeper fib supports at 5,820 and 5,759, which would put the recent relief bounce at risk. So for now, the bulls just need to protect the current levels and show that they can build a higher low before any meaningful year-end rally can take shape. But there seems to be some signs from major index players despite continued net foreign selling. Corporate buybacks have stabilized some stocks. So most index names are also bouncing off of some key Fibonacci support areas. So we have to see how the markets open on Tuesday, whether buyers can build on the bounce we saw late last week or if the setups lose momentum again. So a solid follow-through day early next week could set the tone for a more bullish stance going into the holiday break. Now over to the global markets, let's look at the S&P 500. The index locked in its second straight week of gains and is now sitting just a stone's throw from all-time highs. And really, it's tough to stay bearish this close to the holidays. With everyone busy with year-end errands and celebration, most traders will likely just keep their positions untouched until January, which means that there isn't much pressure for the markets to pull back. The markets could overcome the 6,900 resistance level this week leading up to the Fed rate decision, and hopefully we don't trigger a sell-on news by then. Last week, I got a number of inquiries on the stock screeners requesting for more information on how it really works. Monday being a holiday would probably be a good opportunity for us to scan some names, especially if you're missing the markets. And with the market as boring as and as disappointing as it is, no? So stock screening is actually just a part of a whole process, and I'll share this system with you. So the whole process really starts with stock selection, and we filter the stocks based on their growth, margins, return on equity, and return on investment, and their debt levels. So usually I spend 1 to 3 months just looking at the screeners, seeing some recurring names, and then research on those names. And when I make a decision, I open a position on that stock name. Again, I use the CREST checklist chart, catalyst, risk, entry, exit, and the size I want when I open the position. And after I buy that stock, I monitor the business. I monitor if the business is improving or deteriorating. If it's deteriorating, I ask if it's temporary. If it's just a temporary deterioration, I'll hold. If it's a change in the fundamentals or if it's a major deterioration, I'll sell. Sometimes I can monitor further if I'm not too sure. If the business is improving and if it's not deteriorating, etc., I'll hold, right? And I'll let my winners run. And just to share with you a different stock screener, I also use this website called Finvis, Financial Visualizations. There is a screener portion there that I use to screen stocks. I usually select all, And then again, I use mid-cap stocks and above. We screen for growth, EPS growth this year, 15%, sales growth, 15%, sales growth in the past 3 years, 10%, return on equity over 15%, return on invested capital over 10%. They need to have gross margin should be above 15%, institutional ownership above 60%. The price should be trending upwards. It should be above the 50-day and the 200-day moving averages. And there should be volume. Of course, when you select stocks, there should be volume over 400,000 for US equities. And these are the results. We have 28 names. Some names I already have, like Amphenol Corp. I already have Uplovin Corporation. I have Broadcom. I have CRDO. I recently entered First Solar. I have Insight Corporation. I have Kinross Gold Corporation, which we featured in one of our episodes. Eli Lilly, of course, I had that stock ever since I started this vlog. Page 2, we have some familiar names, Reddit here, Shopify, etc. So it's up to you which stocks you want to select. Again, we go back to the screener. In TradingView, we use the same criteria: revenue growth 15%, ROE 15%, or ROIC 10%. It should be trending upwards, and the volume should be 400K. Unfortunately, TradingView doesn't have stats for institutional ownership, but we can see again some recurring names here. CRDO, we have Uplovin. Palantir is, I don't have a position in Palantir, but it's on my watch list. Broadcom, Eli Lilly, Insight Corporation, APH, Lam Research, EAT. Also have EAT in my portfolio, Brinker International. EAT is the franchise for Chili's restaurant, right? Micron Technology, First Solar, etc. So there are some recurring names here. Some names appear in Finviz that doesn't appear in TradingView, like Kinross Gold Corporation. And so I use the screener just to give me potential names that I can study. So again, when we enter into a position, we look at the chart, catalyst, risk, entry, exit, and size. Now for the chart, you can actually use Finviz and choose chart as your view. And usually I would select a chart that is really trending upwards and would avoid charts that look like this or look like this. So I'd select a chart that is trending upwards. See APH, Uplovin, Broadcom, they're all trending upwards. And for catalysts, you have to look at the story for each of these. So for example, this week I entered into First Solar. If we look at the financial for First Solar, revenues have been very stagnant for the past years, but look at the recent years, 2023, 2024, and the trailing 12 months, it's growing by 26%. Net income has improved from negative to 830 million, 1.29 billion, and 1.4 billion. If we look at the statistics, also look at the annual, the PE ratio is still quite cheap. Return on assets improving from negative to 8, 11, 11. Return on equity 13, 17, 16. Return on invested capital also improving in the last 3 years. But there's also risk. First Solar's main risk come from the cyclical nature of solar demand. And also, as they are bringing more of their factories online, execution risk exists as some delays or cost overruns can happen. And of course, just like any company that relies on government policy support, they are sensitive to political shifts or changes to the Inflation Reduction Act tax structure. So, given all of these information, I would now enter. Usually, if it's trending upwards, I'll buy the dip into the 20 or the 50-day EMA. And of course, the exit plan will always be about monitoring the business. Again, if it does better, I hold. If it doesn't do better, if the business deteriorates, I sell. So that's the exit plan. And the position size, of course, you should have a rule for your position sizes. For my Philippine portfolio, I just manage 10 to 15 stocks. So the position sizes will only be 5 to 10% for each position. For my global stocks, I usually maintain around 25 names. So 25 names, each position will only be around 3% of my total equity. And if a position reaches 15% of my portfolio, if a stock improves and reaches 15% of my portfolio, I realize the gains and I cut that down to around 8 to 10% so that I can avoid concentration risk. So that's the whole process. I use this process also for my local investments. Again, you just have to have a strategy, a trading plan that you follow. And all of this process really takes years and years to cycle through. A lot of people have also been asking me what trading platform I use for global equities. If you're outside of the Philippines, you can use the likes of eToro, Robinhood, or Interactive Brokers. Personally, I use Interactive Brokers for my US investments. I used to have an account with eToro, but as you know, we were forced to close our eToro positions towards the end of 2024. And of course, me being a bit sentimental, I took a screenshot of my eToro account before I closed it. And just to show you how the process is used, these are the top 10 positions in my eToro account. You see here names that are still on the screener: AppLovin, Eat, Broadcom. I mean, AppLovin, I've had this stock since it was 39. It is quite possible for you to have what's called a multi-bagger using this screening process. 786% profit before I close my positions here in eToro and moved it into IBKR. Overall, my eToro portfolio gave me a return of 63.13% in 2024. And my current IBKR portfolio looks like this. Again, AppLovin is there, CRDO, some familiar names, right? SSR Mining, I've featured this in one of my episodes, Alibaba. Now, if you look at AppLovin, I closed the position at 331, 700 plus percent gain in eToro. I opened it at Interactive Brokers back in 2024, and the price of app is now 684 for a 100% gain so far. But actually, if you think about it, from 39 to 684, that's almost 2000% gain. These are the worst performing positions in my portfolio. I've just opened up a position in First Solar. Unfortunately, it went down, but it's fine. I usually take around 6 to 9 months to evaluate. APH, I've just opened it. Insight Corporation, not doing that well. Core Mining also not doing that well. The overall performance for my Interactive Broker account, I do get some bad months. Again, not all picks will be successful, but overall, since inception, my IBKR portfolio has gained 36.5%. Hopefully, you can find the system useful. I use the same system for local companies, but I only maintain around 10 to 15 stocks. No? Now, stock investing is more than just picking what stocks to buy and hold. It's really like owning, for me, it's really like owning a business. You monitor the business and track how the business is doing over time. Ideally, for most of us, it should be as easy as buying and hold. If you want that, you just buy an S&P 500 ETF or a global asset fund and just hold it forever. Unfortunately, for the Philippines, it's a stock pickers market. As of now, if you've had a Philippine Index Mutual Fund and you've held it for 10 years, chances are it might be negative or you're barely making a profit. As we wind down the year, I guess it's a good time for me to share some of my thoughts. When I prepare my vlog, I always evaluate my content and ask myself, is my content valuable to you? Is it relevant? Does it educate you? And how does it contribute to investor knowledge? I don't like showing my portfolio because is it really meant to inspire or to brag? And oftentimes the line between the two, to inspire and to brag, it's very thin. And if you find me crossing the line, just drop me a note. All feedback is appreciated, whether good or bad. But I do understand the world has become a dangerous place for investors. Now, we are investing hard-earned money and we want to be careful who we trust and who we listen to. My content is free and it's not like there's a requirement to prove anything. But the nature of content I provide does involve real stakes, real money. I was thinking maybe, it's understandable that some level of effectiveness, has to be demonstrated. So my content really is not designed to be followed. It's designed to educate you, to help you ask the right questions and make decisions that you can stand by so that you can have more confidence and conviction when you do your trades. Looking back, I realized that I launched my first episode in November 14 of 2022. It has been 3 years. Time flies so fast. We don't celebrate Thanksgiving here, but it feels like a good time to thank everyone for sticking around and growing with this channel. I hope your investing journey has been and will continue to be practical, interesting, and rewarding in your own way. And remember, we're not competing with each other. As investors, we are competing with ourselves. It's not about who's the best trader or who made the biggest gains, right? And I remember when I opened my eToro account, there's a disclaimer there. 70% of retail investors lose when they trade. And this stuck with me. And it just shows how easy it is for retail investors to go off track. And a big part of that is behavior. Most traders don't lose because the market is impossible or it's rigged or what. They lose because they chase, they compare, and they react emotionally instead of following a trading plan. So don't fuss about buying at the exact bottom and selling at the peak. That rarely happens. Don't let other people's massive profits get in your head. The moment you start trying to beat someone else's return, you stop thinking clearly, and that's when mistakes happen. Now, stick to your own strategy. Focus on small, consistent wins. Um, they don't look exciting day to day, but over time, they compound into something really meaningful. No? So at the end of the day, the goal here is simple. I want as many of you as possible to actually make money. Not every trade will be a winner, but over time, I want your portfolio to grow, outperform the markets, beat inflation, beat fixed income to reflect the value of time, and effort you put into learning this. So that's it for this week. Please like this video if you found the information. Please subscribe to the channel for more updates. And again, good luck on your trades. Please manage your risk accordingly. And I'll see you again next week. Bye-bye.